The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 4th of October. Welcome back, Jeremy. Good to have you here again.
Yeah, good to be here.
Feeling a bit autumnal as we look out the windows this morning.
Yeah.
And just over 3 weeks to the budget. So things are moving forward.
We're in Q4.
We are in Q4, yeah, absolutely. And from what I've seen, it's been a relatively quiet week in terms of the UK markets, but there's been quite a lot going on more broadly in terms of the macro situation and quite a lot going on, particularly in China and Japan. So what have you been looking at?
Well, I think the main features this week have been the headlines generated and, well, the real impact of what's going on in the Middle East has clearly widened and become more impactful on global markets, particularly in the last few days on the oil price, which has spiked sharply, and the ongoing situation that we talked about last week, which is the dramatic recovery of the Chinese equity market, which I think is probably broadening out into a greater interest and a brighter outlook for emerging markets generally. And I think on the China point, I like the comment this week from Duncan McInnes at Ruffer, who said that he'd never seen a market go from being completely uninvestable to a state of FOMO in the space of a week, which I thought was neatly summed up.
For our older listeners, FOMO means fear of missing out, just to be clear.
So wouldn't touch it with a barge pole and now can't get enough of it. And that is basically the way the investor perception of China has been in the space of less than 2 weeks.
And what do you think's prompted that? What was the thing that kicked that off?
It was the Beijing Bazooka, what we talked about a couple of weeks ago, which was China's Draghi moment of whatever it takes. And where Western investors have been caught is that we were all focusing on, and guilty as charged here, the imbalances in the Chinese economy around its residential property sector. And I think we'd overlooked the importance of the reality that China is continuing to overtake the West in nearly every industrial and manufacturing sector. You just got to look at things like EVs and automation generally, that China is stealing a march on the rest of us. And I think that we have pretended that that hasn't been the case, perhaps.
Yeah, so huge advances in many other sectors or segments of the economy. And yeah, I mean, it's easy to look at the house building sector and see huge overcapacity and lack of demand. But in other areas, business as usual, they've been marching ahead and doing very well.
Basically, in terms of global capital flows, the narrative has been that China has been experiencing extreme capital flight. And now, in a world that I think is becoming increasingly volatile in terms of the direction of our capital flows, that this capital is now, all of a sudden, has about turned and is now trying to get back into China. But as I said, I think there's also evidence that this is impacting other emerging markets as well, and markets globally, markets more widely as well. So yeah, we've had that in China. We've also had political change in Japan week on week, which has had much less attention in the press. But we've now got a Japanese Prime Minister Ishiba, who's believed to be more motivated to, shall we say, contain inflation and therefore more likely to welcome higher interest rates, so more rapid normalization of rates. And on Monday of this week, Japanese equities fell by something like 5% on news of this. And of course, there's immediate fears of the yen carry trade and the impact that that had on our markets in August. Now, during the course of this week, we've obviously seen things eased off because we've seen the dollar rallying because of Middle East tensions. But I think Japan has definitely tried to rear its head again into these times, saying, don't forget us, we're here, and we are suffering from inflation, and we have interest rates that currently mean we can do very little to combat inflation. So all of a sudden, with rates now starting to fall in the US, massive stimulus coming in China, and Japan doing what it's doing, we're in a period of increasing volatility for currency movements and for capital flows. So I think while equity markets are taking this positively, there are always unintended consequences that one must be mindful of and look out for here.
Yeah, of course. And that's fascinating. So just make sure I've understood that. So you're suggesting that because of the Middle East, the flare-up of tensions and obviously the risk of that developing further, that led to the dollar strengthening, which meant that the risks around the carry trade actually didn't manifest themselves quite as badly this last week as they might have otherwise done.
I think so, yeah. I think that's broadly correct, yeah.
Okay. So lots going on there. Closer to home, have you seen anything much going on in the UK market?
In the UK, we've had nationwide September house price data, which showed one of the highest month-on-month changes in house prices for a couple of years. And I think it was also accompanied by data suggesting that housing transactions are picking up as well in terms of mortgage approvals. So a bit of a boost to the UK housing market. We've also had this week EU-wide inflation data, which fell materially below the 2% level. So obviously good that they're on or now marginally below target, but I think one needs to be vigilant to the degree of deflationary pressure now emerging in the wider Eurozone area. And with concerns around the deindustrialization of Germany and obviously ongoing issues in France, then while inflation is clearly contained, one then has to worry about the flip side of that and the prospects for economic growth and employment.
Yeah, I mean, there was a lot of talk about whether the US could achieve a soft landing, but I think trying to achieve a soft landing across the whole Eurozone is probably an even bigger challenge.
Yeah, there are definitely some concerns around the debt situation in France, and I've heard, growing anxieties on that front. So, yeah, I think it could be a case where eyes are on how the US get on with bringing their economy down for a gentle landing. And I think maybe we've sort of got the eye off the ball a bit in terms of how the Eurozone manages it. Well, it's not really a case of bringing it down from an elevated level in Europe. It's more a case of whether we get it off the ground in the first place, I suppose.
Not stopping it in its tracks. No, I think it's probably right. Okay. And what about company news? Any exciting company news?
Yeah, the UK stock market, I think, is beginning to show its purpose in life in weeks like this week. There's a lot going on. So in no particular order, we had an indicative offer for Learning Technologies, which is an interesting sort of mid-cap company. The offer came from private equity, which would probably value the company around £800 million. And the Learning Technologies board have sort of said they'd be mindful to accept it were it to be formalised. We've got the comings and goings of the Murdoch Australian vehicle that's been trying to buy Rightmove. They've rejected it, and it looks like REA of Australia have sort of walked away. We've got news of a imminent IPO coming to the London market of Applied Nutrition, which would value that company around £500 million. We've got Frasers trying to buy Mulberry and Mulberry rejecting their offer. We've got small raises from a number of small cap companies like Empac raised money, the packaging machinery company, to do quite a sizable deal, actually, and raising equity in the process. Creo Medical raised a bit of money in an accelerated book build. And in the large cap space, Pfizer offloaded part of its stake in Haleon worth £2.5 billion. So there's just lots going on in terms of capital market activity. And I think that feels a lot healthier than where we've been for a lot of the last, feels like, couple of years, but certainly year to date. So what about you? What have you seen in the market this week? What have you been looking at?
Well, in the progressive stable, some of the micro caps have had a little bit of news, and one slightly bigger stock in STV. So the smaller ones, we've had H1 results from TinyBuild, which makes relatively low budget, small computer games. They released their first half results, and what they're seeing is an increased focus on own intellectual property, which is starting to bear fruits, which is good to see. It's still a very tough space that some of the big players in that market have made it very difficult for some of the smaller games developers. I think for Tiny Build, they've also suffered from the fact that a large number of their workforce are in Ukraine. So they've been dealing with all the challenges and difficulties that come with that. So it's been a tough time for them, but some signs of light at the end of the tunnel and a bit of optimism for the second half. So still risk, but some improvements underway there, which is good to see. We also had a positive update from Petrometad, the Mongolian oil and gas business. They're hoping to get their Heron 2 well on stream in the coming weeks, which would be great to see. And then finally, STV, slightly bigger stock, Scottish broadcaster and content producer and streaming business. They saw a halving of the valuation of their pension deficit. So the pension deficit's come down significantly. They are seeing a benefit in terms of their cash payments into the pension plan being reduced over the coming years, which, as they pointed out, obviously gives them greater flexibility to use that capital elsewhere. So a nice positive result from the actuarial valuation coming through for STV, freeing them up to do a bit more in terms of potentially M&A over the next few years. So good to see that. And they've got a new chief executive. So it'll be interesting to see how he decides to deploy that additional capital, which he's now got at his disposal. And again, a bit like your comment on the broader markets, some positivity showing through there and hopefully some signs that the market is at least normalizing and starting to improve. So some good things there. And we'll have to see how things evolve over the coming weeks. And obviously, we've got the budget, which I think a number of investors are worried about in terms of what Rachel Reeves might do in terms of the taxation around AIM stock. So there's still a sense of concern out there. But in terms of corporate performance, doing not too badly.
Yeah, I think given all the things that are going on in the rest of the world, the UK continues just to carry on. There has been obviously concerns around what is going to be contained in the budget. That's quite normal, quite natural. And I am increasingly of the view that they've flown all the kites of the potential negative impact. And they've got the sort of bad news out up front. And I think there could be a bit of a sigh of relief come the end of the month. So, yeah.
Absolutely. I think we discussed before, capital's being positioned carefully just in case there is a big change. But if there isn't a big change, then, you could see quite a rally. So, yeah. And the companies underneath all this are performing not too badly. There is a theme that people have been cutting their cloth to suit the economic conditions that we've had for a number of years now. And that cloth has been cut. And these businesses are performing not too badly despite the difficulties which are still out there. So, yeah, it's not a bad place to be. Okay, great. And then what about looking forward to next week? Anything on the horizon?
Well, first of all, later today, we're going to have the US labour market data. We've got the non-farm payrolls, which always add a bit of extra spice to the end of the week. Last month's figure of 142,000 was considered to be a low number. This month, the figure is expected to be 130,000, with an unemployment rate ticking up from 4.2% to 4.3%. Now, we know that the labour market is what the Fed are now focusing their attention on. So I think we've got to play the good news is bad news or bad news is good news trade on this labour market data to just get a handle on how quickly the Fed will continue to reduce rates later this year. But yeah, that's later this afternoon. Next week, we've got US inflation data on Thursday, which is expected to remain stubbornly above the 3% level. And then on Friday, we've got GDP data for the UK, where we had a surprisingly unchanged number last month. And I think most expectations are for a small improvement this month. But there again, I think there's evidence that noises from government around confidence in the economy possibly keeping throttled back a bit that maybe could be unleashed if we have an okay budget at the end of the month. So I think it's quite a lot resting on how things shape up for this budget on the 30th of October.
There is. And as we said last week, if the rest of the Labour MPs get the message to stop being so negative about things, then maybe they'll start talking it back up again, which would be nice. So, yeah.
You never know.
We'll see what happens.
Yeah.
Great. Okay, great chatting. Good to catch up, and we'll speak this time next week.
Okay. See you then.
Talk to you then. Thanks a lot.
Brought to you by Progressive Equity.